Ganga, back to you.
If you
I want to make some.
No, yeah, you guys can.
But I'll come back to it.
Just be aware. Just be aware. I think the more you talk, the less you will get to talk on the next question.
Okay. I'll stop here.
All right. Yeah, sure, please. Or actually, I'll do one thing. Let NS complete his comment, then you can take that. I'll give you a chance. I think if there is one person who is genuinely moderate by his personality, that's NS Venkatesh. Of course, Professor Nachane is going to give us an overview. So I'd like, he's a true moderator among the market participants. So I'd like his comments.
Thanks, Dr. Gangadhar. Let me also thank BSc for inviting me to this panel, which is a very, very eminent panel. And let me at the outset say that I'm not an economist, so I do not know anything about economics. But I'm here as a practitioner, just like what Anant has been telling. And having seen as a practitioner over so many years as to how the monetary policy has evolved itself, I think we have seen a great sort of development happening in the monetary policy. The monetary policy has looked at various aspects. Countries which have looked at only inflation targeting as the panacea for everything, they themselves have moved to something beyond inflation targeting. We moved from the Keynesian side of, let us say, only the fiscal adjustments for all the panacea to, let us say, from 1960 onwards to the monetary aggregates. And we are looking at various ways in which to use the monetary policy to ensure that the public good is completely taken care of. But I would say that monetary policy is not the panacea for everything. It can support the fiscal policy. That is what I think the next topic is. I believe that why, if you say the monetary transmission is not happening, why only inflation targeting should not be the most important or paramount thing. You need to look at different factors, and it depends on the economy, or it depends on the structure of the economy of each country, and to that much extent, maybe the monetary policy should be designed to cater to that economy. When we looked at, let us say, what Neeraj was trying to say, that there is no linkage between the bank lending and bank deposits. See, the monetary policy will function effectively if you look at, let us say, if the rates are changed and immediately, let us say, the bank deposit rates gets changed or the bank lending rates gets changed. That can happen only when in a floating rate sort of an economy, where a developed economy is there, where essentially your entire assets and liabilities are getting priced based on a particular benchmark, which is itself floating. So to that much extent, when you change rates and you are trying to give an indication about how the monetary policy is looking at to contain inflation or to maybe shift their focus towards increasing labor and output, I think to that much extent the markets also react to that, and through the markets, maybe the bank channel also gets the reaction in line with the monetary expectations. If you look at up to, let us say, 1989, maybe it would have been okay, because in India, up to 1989, you had a deposit rate which has to be fixed as per RBI standard. The advances rate also is fixed as per RBI standard. So to that much extent, when RBI increases rates or decreases rate, automatically the deposit rate and the advances rate will also attune themselves to that particular mode, and automatically the monetary transmission could have been better. But when you started opening the economy and saying that liberalization of the deposit rates, liberalization of the lending rates, but both the deposit and the lending rate happen to be fixed sort of thing, and there is absolutely no market which is developed, then it actually becomes very, very difficult for, let us say, the central banker himself to say, how do I use the various monetary policy tools to ensure effective transmission of the monetary policy, and by that maybe look at containing the inflation or even the inflationary expectations for that matter. If you look at it from this angle, I would say that what again Neeraj just said, that there should be a linkage between the bond and the loan market. In India, the market infrastructure is not that great. in the sense that it is purely a loan-denominated market or loan-dominated market, then you could turn around and ask Germany is also like that. But still, I would say that in a country like India, where there is actually very, very shallow markets which are there in the fixed income side, and you are trying to implement a monetary policy through the bond market and then trying to pass it on to the loan market, I think the transmission will be weak. I agree with what Sajid is talking about the liquidity part. Yes, we have seen that essentially when you look at when liquidity is tight and then you actually raise the interest rates, the monetary transmission becomes much more faster. So the key here is actually how do you ensure that the liquidity is a channel through which the monetary transmission is effected. Great credit to the Reserve Bank. At least they have announced the policy rate and also announced the operating rate and said that we would like to have the operating rate, which is the overnight rate, to remain within the policy rate, and they are actually trying to manage the day-to-day liquidity in such a way that the operating rate is within the policy rate normals. So I think that is why you are now trying to see that the liquidity is stabilized, and you are ensuring that through whatever is the mode that you are trying to do, that you are ensuring that the liquidity is actually sufficient for the monetary transmission to happen. And the market is seeing that there is a stable liquidity environment. The market is seeing that there is a stable exchange rate environment matter, because exchange rate channel also plays a very, very important thing, which we saw in May 2013, when essentially the exchange rate was going for a toss. You had to use the interest rate channel to defend the exchange rate. So maybe we need to we need to factor in the exchange rate also into our monetary policy considerations, and then try and see how do we ensure that in various scenarios of maybe capital flows coming in, capital flows moderating, or capital flows going out, in addition to your inflation and growth sort of parameters, how do we manage the monetary policy? So I believe that there are various parameters under which the monetary policy is working. It is not only on interest rates, and I also believe that the transmission in India is weak for the simple reason that the underlying economy is a bank-dominated economy, and the bank-dominated economy is working on deposits and advances on fixed rates rather than on floating rates.
Prachi.
Thank you. Thank you, Ganga. Just 1 minute to respond to Neeraj's point that, the upshot of my presentation is not that monetary policy does not work. Basically, what we found in our study is that, in the number of studies I've done, is that on average it tends to be weaker than in developing countries. Monetary transmission tends to be weaker than in advanced economies. So it's not like, one corner, it does not work or does work. It depends also on a number of things. As I said, it tends to be unreliable in the sense that it depends on how competitive your banking system is, how well developed your financial structure is, how, how strong your institutional environment is. So it's, the whole point is that, monetary transmission depends, on average tends to be weaker in developing countries relative to advanced countries, and it depends on a number of factors in any countries. So, it's not like a magic wand that you change the interest rate and, boom, the output and inflation gets affected. There's a whole series of steps in between monetary policy and aggregate demand. And, a lot of reforms you're doing, for example, in the financial sector could actually be important in increasing the effectiveness of monetary policy. So that's, the basic, there's no it's not a corner solution that, it works or it doesn't work. On average it works, it's weaker in developing countries than, compared to the more advanced economies.
You provoked one interesting joke about, you said on an average it works. It's in an interesting anecdote somebody once told me, if one of your leg is in a refrigerator and another leg is in the fire, on an average you are safe. But you are hit on both grounds. Now, as you can see, actually that's a joke. You don't have to, that's not a comment.
But again, the point was that, it's not that it works or it doesn't work.
It works sometimes.
No. On average, it's, the effect is smaller. I mean, that's the point, right? So, of course, in some countries it's stronger. It's not 0-1. I mean, that's the point.
Sure. I think, as you can see, the academically trained people's view seem to be contrasting partly with the people in the industry who back their view with the money. So obviously, when you have two views...
What are you, academic or are you practitioner?
No, I'm a moderator, so I can get away with both. So I think when you have such a, sort of a contrasting views, the best thing is to go to the vice professor to make a comment on what he believes the discussion is. So let me request Professor Nashne to make a comment, please.
Thank you, Gangadhar, for calling me wise. Very few people have done that. Okay. Well, there are so many things wrong with monetary policy that I really do not know where to begin. Well, I will begin with an article which I wrote some time back, okay, and which, like all my articles, does not seem to have been read by many people, okay. But you see, there I had said that, you see, I mean, I had said that what is happening in India or countries like India is that the transmission belt of monetary policy is slipping. Not sleeping, slipping. S-L-I-P-P-I-N-G. You see, you have a transmission belt, but it frequently keeps on coming off the thing. And I think, so therefore I agree with Dr. Mishra that transmission is not working very effectively. But I'm not sure what are the reasons why this transmission belt is slipping. I think one set of reasons was given by some of my friends from the financial markets and the corporate sector, and her econometric results threw up a sort of threw up certain stylized facts. But as somebody who is neither connected with the corporate sector, nor with financial markets, nor with regulators, okay, I feel that one could say in general about 5 different reasons as to why the transmission between money, okay, credit, and the overall macroeconomy is rather weak, not only in countries like India. You see, I don't agree with Dr. Prachi when she says that the transmission belt is working very effectively in the advanced countries. I mean, even in advanced countries, it does not seem to be working very well. Okay? Monetary policy is coming under a great deal of cloud, especially after the global financial crisis. Okay? We showed that monetary policy was largely ineffective, okay, in the sort of ensuring financial stability. I think the first reason that I see as being responsible for the slipping transmission belt is the rapid financial innovation. Okay? Financial innovation has been extremely rapid, okay, and substitutes for money are emerging almost on a daily basis. So really, when the monetary authority is trying to control monetary aggregates, or when it's trying to control credit aggregates, what exactly are we controlling? Okay? Because the near substitutes for money are multifarious. Okay? I mean, earlier we had 2 or 3 measures of money supply, M1, M2, M3, and then M4, and now M5, M6. I don't know. Maybe it goes on up to M7, M8, M9. Okay? But which of these aggregates to target? Now, targeting the interest rate is what seems to have been done, okay, and that itself is controversial. And that itself is part of the reason why the transmission belt has become weaker. There has been a remarkable decline in the total amount of credit flowing through the banking channel. Okay? Today, you see, in the good old days, banks were the main source of credit. But today, if I don't have the exact proportions, but I think banks would barely account for about 55% of the total credit in the economy. A lot of credit is being passed through the so-called non-banking financial sector. And really, monetary policy is all about controlling bank reserves or targeting bank reserves. Okay? There is no monetary policy, or let me put it in another way, non-banking financial companies are really outside the ambit of monetary policy. Okay? And this, I think, is one of the major reasons why monetary policy is becoming increasingly ineffective. Global capital flows are another reason. Global capital flows are another reason. And I think I have always been a critic of unrestricted capital flows, you see, right from the first Tarapur committee. At that time, of course, the prevailing IMF orthodoxy was to allow full capital flows. Now, increasingly, the IMF is switching over to what are called as capital management techniques. Okay, it is being recognized. It is being recognized that unrestricted global capital flows can create lots of difficulties, and that capital management techniques are being recognized as an integral component of the regulatory, of the regulatory armory. But my main point is not so much about transmission as about the fact that there are two major lacunae in the monetary policy framework as it operates in the Indian context. Apart from the inflation targeting, about which a lot has been said and written, okay, and on which I don't want to spend much time, but I would like to spend some time on two very important aspects on which virtually nothing seems to have done, both in the advanced country context, but more so in the Indian context. See, and the first refers to what is called as the Jackson Hole consensus. Okay? Now, prior to the global financial crisis, the thinking on monetary policy was summarized in what is termed as the Jackson Hole consensus. And what is the Jackson Hole consensus? That commodity inflation control, if commodity inflation is well under control, then asset prices are also under control. See, during my tenure at the MPC, during my tenure at the first Monetary Policy Committee, I did my best to see that asset prices also come on the radar of the central bank. Because in my opinion, asset prices are an important component of inflation, but also a very important ingredient of financial instability. And this orthodoxy, the so-called Jackson Hole consensus, meant that if you kept commodity inflation under control, then asset prices would be automatically under control. Okay? And this, the basis for this, of course, is the famous work by Friedman and Schwartz, okay, and later on Anna Schwartz, saying that to quote from them, central banks should view price stability and financial stability as highly complementary and mutually consistent objectives. But even before the crisis, a substantial amount of literature, empirical literature was building on, which showed that periods of commodity price stability coincided with periods of underlying asset prices inflation. Okay, that commodity price stability could coexist with a lot of asset price inflation. And there are several instances which have been given by some of the BIS economists like Claudio Borio and so on. Now, the orthodoxy at that time was that central banks should not bother about asset prices. That central banks should not be bubble prickers, but they should be bubble moppers. Okay, this is the famous this thing that central banks should not worry about asset prices, but they should not prick asset bubbles. But when the asset bubbles actually burst, they should come in with buckets of liquidity and mop up the mess. Okay, I think this orthodoxy has been very seriously challenged, by the global financial crisis. After the global financial crisis, most central banks are increasingly recognizing that asset prices have to be on their radar. Now, there are two views. Even if asset prices are on your radar, whether asset prices should be used as indicators of monetary policy or should they be used as explicit targets of monetary policy. And I think here, the influential economist Goodhart has already made out a case for explicitly targeting asset prices. But at least, in my opinion, if not explicitly targeting asset prices, possibly because it is difficult to get reliable series on asset prices, okay? Now the Residex is there, the price index. But I think at least asset prices should be used as indicators of monetary policy. I'm not part of the monetary policy committee now, so I am really ignorant about whether asset prices are still figuring in the calculations of the Reserve Bank of India. But I think if they are not, they should certainly do. The second point that I want to emphasize is the complete ignorance of lags in monetary policy. Okay, you see, except for the Bank of England, which explicitly includes fan charts, okay, for horizons up to about 24 months, most central banks, including the Indian Central Bank, okay, ignores lags altogether. And ignoring lags is especially dangerous. Ignoring lags is especially dangerous for an inflation targeting regime. Because if there is a disturbance which raises inflation, you have to specify, and if you are an inflation targeter, suppose the inflation rises from 5%, which is, say, your comfort level, to something like 7%, you should specify within what time frame you would like to bring it to 5%, okay? If you adopt a very shorter time frame, then you have to pay a high cost in terms of volatility. If you adopt a longer time frame, then you may have less costs in terms of output volatility and output loss, sacrifice ratio. But at the same time, you see, then you'll be taking a longer time to settle down. The Bank of England, and especially two economists, I think Battani and Haldane, you see, in the late 1990s or early decade of this century, conducted several studies on what is the optimal horizon for monetary policy. And they came up with something like 18 months or something like that, which is suspiciously close to the 19 months lag obtained by Friedman. Okay. Now, I would suggest, okay, that empirical work along these lines must be initiated in the Indian context. Econometric work along these lines should be initiated in the Indian context so that the Urjit Patel Committee does try to do something of this kind. But I'm afraid that it does not specify exactly the econometric model underpinning this kind of an analysis. So I think that is one thing that I would like to say. And then, before I conclude, I would like to pose one more conundrum before this panel and before the general audience. And that is, the Phillips curve in almost all countries is now flattening. Okay? There is considerable evidence that the Phillips curve is flattening. And this is dangerous evidence. Because this shows that if you have to lower inflation, then the output sacrifice which is required is correspondingly high. Is there an Indian Phillips curve? Does anybody have estimates of the Indian Phillips curve? And has it really flattened out? Because if the Indian Phillips curve has really flattened out, then attempts to lower inflation can have a very high cost in terms of output sacrificed. So I think, while in some senses, you say I don't want to comment on the monetary policy because, I do not know all the facts, or I do not know all the insider facts. But if the RBI is very keen on controlling inflation, and if the RBI is very serious on controlling inflation, then I think it must also make serious econometric efforts to see what exactly is the shape of the Indian Phillips curve. Thank you.
Thank you, sir, for a lucid comment and an interesting question that's being posed. I think we are running a little behind schedule in terms of time and the number of questions. But I don't think there's much of a restriction on number of questions to be covered, rather than understanding the question in its clarity. We have an option. I think probably I would exercise my judgment as a moderator. Instead of going to the next question now, I'd like to take the discussion to the audience at this point, and if there are a number of responses from the audience, we would like to go with it. If there are not, then we would like to go into the next question. At this point, can I invite, in particular, before the audience, open up to the audience, can I invite Professor Chitre, Vikas Chitre, who is a very well-known macroeconomist in the country, to make his observations on the discussion so far.
Thank you, Gangadhar, for inviting me for this excellent discussion that you have been having here, and I have been really enjoying the discussion and comments from all the panelists. I have 3 points to make, and let me begin by making the point about the Phillips curve, which Professor Natsde made, which is a very important point. Although I will not go to the extent of saying that anyone has estimated Phillips curve. But you see, he made the reference to flattening of the Phillips curve. In his article, he has made the reference to the backward bending Phillips curve, which was a contribution of Akerlof and Yellen and others. Now, the relevant point of that is, you see, if the Phillips curve is backward bending, then and even the long-term Phillips curve happens to be backward bending. That is what the contention of Akerlof and others. Then in that case, you see, if you target inflation, at what rate we have to target inflation is a point which needs to be determined. For example, there are 2 points relating to this which I shall make. First point is, you see, when the Urjit Patel committee report has said 6.2 as the higher limit for inflation, they have drawn this result from a certain exercise of estimating what is the maximal growth rate that is possible. What is how much inflation can be allowed to be raised without it begins to hurt growth. That is the threshold inflation idea. Now, between 6.2% of inflation and 4.4% inflation, which is where the output gap is supposed to be zero, what is the loss of growth of output is not told to us in that report. So between 6.2 and 4%, how much growth will be sacrificed? We don't know. For that, we have to go behind the estimates of how this 6.2 was arrived at, and I tried to get this working paper from the Reserve Bank, but I could not get the proper response. I got only from them, I got only the impulse response table, but we need to know the coefficients of the estimated function, and from that we can estimate how much growth is sacrificed when you go from 6.2% to 4% or from 4% to 2%. And sometimes this sacrifice of growth can be enormous. I will give an example. You see, the Akerlof and another Canadian economist whose name I forget, they did a comparison between the US performance of inflation and unemployment rate and the Canadian experience of inflation control and unemployment rate. Canada is following a strict inflation target of 2%. US is having not even a flexible inflation target, but they have an inflation target as well as an unemployment target. So it means they use a mix of growth, a mix of goals, whereas Canada uses only one inflation growth target. Now, what emerges out of that is American unemployment rate is much lower compared to Canadian unemployment rate. American unemployment rate may be about 7% or so, but Canadian unemployment rate is very high. If I'm not mistaken, it is something like 18-20%, which of course I stand to be corrected for the figures, but it's extremely high, which means by sticking to a very low inflation rate, you are sacrificing a lot of employment. As in our case, it is likely to happen if we choose a wrong inflation target rate, 4%, say, for example. We may end up sacrificing a lot of growth. Now, there is no estimate of how much growth is being sacrificed. That is the point of this. Now, my second point is, of course, now they are moving as far as the financial stability question, which also was mentioned by Dr. Nachne. There have been efforts, of course, most of the panelists would know this. One, like the UK Bank of England, they have moved to including value to loan to value ratio, the ratio of the mortgage loan to incomes of the individuals, and that this kind of ceiling is put on how much mortgage can be made available to a particular person depending upon his income. Now, this kind of additional tools they are using in order to see that the housing price boom does not go out of control. There are also efforts by economists like Woodford, who have included the premium on credit default swap in the Taylor rule. And so they say this rate will have to be raised much higher if there is a fear of financial stability. But these are efforts which are still on, and there is no unanimity about how the question of financial stability is to be tackled. But it's an important issue nonetheless. My third and last point is in the response to the point which was made by the practitioner, Anand, sorry. Now, I entirely agree with you that many of the questions relating to supply side are being ignored. At least they were being ignored in the earlier discussion of inflation control. Now, recently, they are being brought into the forefront to some extent. But the point of this is that supply side response, to some extent, can be improved by making adequate investments in the kinds of things which you mentioned, namely warehousing, cold storages, and so on, and why this has not happened. In fact, there is no data available as to what extent this has happened. Now, as far as the various other policies are concerned, which are under the central banking gamut, so to say, the credit policy, the foreign exchange policy, etc. Now, if you take credit policy, now if you, just as now recently the RBI has done to allow the banks to issue long-term bonds to finance infrastructure. And this financing of these bonds, issue of these bonds will be exempt from CRR and SLR and priority sector advance requirements. Now, this is a kind of thing that needs to be done to see that flow of credit goes to those sectors which are required to take account of supply side bottlenecks. In other words, most of the discussion of monetary policy is in terms of demand side. But if the inflation which is coming up is due to supply side deficiencies, then credit policy has to be used for that purpose. How to use that? One has to think very clearly. It need not be in terms of interest rate subventions. But it means this has to be in terms of strengthening credit flow to sectors which need to be aimed at for improving the supply response. Now, the point is that when we talk about monetary policy, we talk about what is called a pure monetary policy. But there are adjuncts of monetary policy, which are other policies under the gamut of central banking policies, such as credit policy, such as foreign exchange rate policy. These also have to be coordinated properly with the monetary policy instruments, with the interest rate policy tools. We, of course, will later on talk about the coordination between monetary policy and fiscal policy. But so all these policies need to be coordinated towards getting one specific objective or one or two specific different objectives. Thank you. I will stop there.
Yeah. Is there any question, I mean, one more question I would like to take from the audience around this particular theme?
Good evening to all the respective panelists. Just I have one question. Just in today's era, when there is there's two states of central bank. One is the advanced economies, another was the emerging economies. One state, it's there. There is a nexus have been developed with the market and the central bank to a certain extent. Like if you see that when there is a fall in the US GDP, but because of the confidence of the further QE, the market is developing. The same thing happened in the Russia. When there is a more and more sanction, the Russian central bank actually assured that the central bank is there. And the last is the China. But on the other side, the other sides of the central bank, which is continuously defending their economy. So how do you think that the two states of the role of the central banks in today's era? One is continuously supporting the market and is trying to develop or trying to increase or augment demand, and the other sides of the central banker, which is always trying to anchoring inflation. So how do you think the role of the monetary policies in today's?
We are actually not, it's resonating a little bit. So we could not get the full gist of what you're saying. Unless one of you want to respond, we can pick it off the line. Or could you figure out the question? No, I think then what we do is, instead of repeating again, as soon as we are done, kindly catch one of us who you think that question is relevant.
And just another small question, not regarding to that. Just one thing is that I think the Madam and Mr. Peter Montel wrote a paper on the Indian inflation. So they are also highlighted the role of the monetary policy when there is a CPI is the component of the non-core food item is very high. So that's actually this trying to give a evidence that it's basically inconsistent. So how do you think, since we are targeting CPI and again the role of the non-core inflation is?
See, good thing is she can't hear even this.
Oh, thank you.
That's okay, but I got the question. She is basically referring to your other paper on food inflation in India and the CPI food combination and the role of monetary policy in that context. Slightly it will take us away from the other question that I want to discuss, but it's good to know that people are reading research papers. As Dr. Nachne said, they are not, but looks like they're reading. What we'll do is, we'll pick that particular question again off the line. We'll definitely talk to you. What I'll suggest is, I think with whatever little another 15 minutes time that we have, 15, 20 minutes, what we would like to do is we'd like to ask a question in the following sense. Does monetary policy, unlike other policies, have an additional degree of freedom? That is, if a monetary policy is badly communicated, it can be less effective. Probably a proper communication of monetary policy would, with the same tools, same objectives, would be far more effective under uncertain environment. Now, the moment we bring that to that, I think monetary policy communication becomes very important. What does that mean? So I'd like to start the market participants' view to begin with, and then we will conclude on that with a relatively academic view. Now, Sajid has been threatening me that he would like to leave in 10 minutes. So let's fix him on the dais by asking him to speak first.
Sorry, I need to go, but I wanted to just respond to Professor Nachin, Professor, your comments. On the committee, we did try and estimate a Phillips curve. It's not easy in the Indian context. Here are the preliminary results that we got, that there is a structural break somewhere around the global financial crisis. That if you look at the pre-crisis period, the relative importance of output gaps versus that of inflation expectations is quite high. Exactly the opposite is true post-crisis, where you get an increasing flattening of the curve. As you rightly said, most Phillips curves in the world seem to be flat. The problem is they're flat at very different intercepts. The US Phillips curve is flat at 2%. India's Phillips curve is flat at 10% for a long time. And what we found is that post-crisis, there are a lot of estimation errors here, so I'm not going to make a big deal about the estimation process, is that the role of the output gap was very small, and the role of inflation expectations, Ganga and I spoke about this several times, was increasingly large. And therefore, the need to go to a monetary policy framework where the overwhelming objective was seen to be inflation management in a means to try and reduce the role of inflation expectations in the inflation generating process. I'll just make two quick 30-second comments. On the target of 6%, again, we're open to criticisms about the locus critique that the analysis that went into those threshold effects did not take into account the regime change that is now underway. What I will say, Professor, is that I'm sometimes a little puzzled by the word sacrifice ratio, because I think it's a slightly partial equilibrium concept. That we talk about what is the marginal impact on growth from a reduction in inflation, but we don't quantify in a more general equilibrium sense what is the cost of high inflation in itself. That we always quantify taking inflation down from 10 to 8 has a certain impact on growth, but who has quantified what is the growth inhibiting role of 10% inflation for 5 years in time? But I'll end with those two comments and not derail Ganga's well-orchestrated process. Thank you.
I think it is said, it is jocularly said, if you put two economists in a room, you get three views. But here, you put two economists, or probably three economists with myself, and then you put investment bankers, we are not getting any better, as far as on the first question is concerned. And I think on the second question, it is related to the first question, because the effectiveness of a policy could be related to the way the communication is done. In this context, when we say communication, it could mean two things. One, the so-called principle of constructive ambiguity. That is, the monetary authorities will have to be ambiguous, then only they can be effective. Let the markets guessing on what happens. And then, of course, the second issue is about the principle of forward guidance. How do monetary policy, on the one hand, be ambiguous constructively, and at the same time, forward guiding to the markets? I want you to hang around for just for a few minutes, because there is an interesting story Ken Ragoff told me in the context of forward guidance. He said, Anand knows about this. He said to me that it's a bit like an old man taking his dog for a walk in the park. And the dog's name is Ginjal. So he's walking with the dog in the park. And he's telling what he's planning to do after his divorce is done. He's fighting a divorce case. So every time he's telling a Ginjal, I want to do this, Ginjal, I want to do that. And then the Ginjal is looking up every time you say that. So every time the word Ginjal is used, the dog is looking up. And afterwards, obviously, it's not following the entire process that he talks about. In this example, whenever, Ken Rogoff mentioned, monetary policy guidance has become a bit like this, with the governor being the old man and the markets being the dog. They react to it only on certain aspects when the communication is actually not very, very clear, or whom you're communicating, how you're communicating. So with that particular background, I'd like to ask Neeraj to initially comment upon, not on the example I gave, but much more substantively on the idea, how does markets see what is an ambiguous policy and what is the value of communication of the monetary policy.
First, compliment the professor for the example, because it shows how economists and markets see each other, right? And I also say that the classical example of communication, of miscommunication, was what happened between me and Prachi when I was making a comment about her paper and her interpretation of that comment. But, two or three things in my mind in terms of monetary policy communication. One was that we seem to have, in a way, moved away from constructive ambiguity, the Greenspan style ambiguity, to a lot more of openness and, trying to communicate in terms of what you're really thinking with the markets. And in my opinion, as a market practitioner, the Greenspan style constructive ambiguity was trying to buy for yourself an option, right? Because you wanted to have as much optionality with you of when you want to act, how you want to act, etc., etc. And now central banks are willing to give up that optionality in order to be more effective. So in some senses, the change between constructive ambiguity and clarity of thought, forward guidance, visibility, considerable period of time kind of phrases is a result of, I would say, in some senses, decreasing confidence on effectiveness of monetary policy, right? And it's also a recognition of the fact that unless and until, and it's interesting to say that Prachi's conclusion about less activism in monetary policy is coming to bear here, because if you're giving a long-term forward guidance, you're committing yourself to far less changes, right? And if you're giving a long-term forward guidance, you're also trying to tell the market that, rest assured, we're going to be here, we're going to be, we're not going to be disruptive. So in some senses, this whole construct of change away from ambiguity, Greenspan style, to maybe Bernanke, maybe Yellen style, more openness, allegedly, is a result of how effectiveness of the monetary policy has changed, point number one. And point number two, how markets have become very dependent upon each and every word of the central bank, right? And what they're trying to see out of it. I mean, I can say a lot more, but I'll just kind of stop here and pass it on to Anand for his comments on this.
Wow, okay, that's a lot of stuff. Okay, I'm going to take a bit of time. I'm sorry about this. First, the comment on the professor and sir, your point about the Phillips curve. Again, a layman practitioner's perspective. For benefit of those who don't know what Phillips curve is, and there are lots, I'm sure there are lots of them out here. These are about choices, right? Economics tells you that you have to make choices. So the first thing we learn in economics is the production possibility frontier, guns and butter. So which means if you have to increase the production of guns, you have to reduce the production of butter. Phillips curve basically says, you have to make a choice between inflation and growth, right? Effective, or rather employment, right? So you have to choose between the two. There's one term which comes across all these, theories, that's one Latin term which the only portion I was awake during that time, during the professor, ceteris paribus. It's all things assumed to be constant. This is what happens. Now, this is where I think sometimes we lose the plot. In a country like India, first of all, we are not on the production possibility frontier. We are well below that. We are underemployed, right? Secondly, the frontier itself can go up dramatically if we invest in things like infrastructure. The efficiency, the production, everything can go up. The question about making choices becomes irrelevant if you actually increase the productivity completely. And sometimes we tend to forget about that. I'm sorry, I'll come back to your question now. I think Neeraj covered it very well. I'll just make a few points out here. One, I think I would love to hear a central banker start off by saying, there are lots of things which I have absolutely no clue about, okay? Where the market will be in 2 years' time, I have no clue about, and that's a reality, right? In 2011, if you had told me dollar rupee will touch 69 and then come back to 63 or 62 right now, I would have said you're nuts, right? No way. But the reality is market did go where it did. So there are a whole series of things for which it's practically impossible to predict, right? Randomly, a few people will predict it correctly. But to say that that one person, central bank governor, knows exactly where the market will settle is crazy. And the earlier we as market participants understand and appreciate that, the better, right? So a corollary to that is, it scares the bejesus out of me when you have one person, one central bank governor whom we expect to be Superman plus Spider-Man plus I don't know what together, taking all the right decisions on policy going forward, right? It scares. I have my points about FSLRC, but the point about having a committee of people doing an average, I think makes a lot of sense rather than one person. To that extent, I think when you see the FOMC minutes, you have this question of dots, where you have each member telling you where they expect rates to be over a period of time or various parameters to be over a period of time. I think that gives a lot of that fan kind of communication to market participants. It tells you that even the experts don't know. And by the way, the market is at a very different dot from the individual dots of the members of the FOMC committee. Now, that doesn't mean that the central bank or the governor can't do anything at all, or I don't know where the market is going, so therefore I'll stay quiet. No, absolutely not. There are a few things where, irrespective of what will happen tomorrow, irrespective of whether Ebola goes higher, irrespective of whether Fed hikes or not, there are a few things which might make intrinsic sense. And those are things to actually work on, right? So my favorite pet topic, in the current context, I think it makes imminent sense for the central bank governor to see how investment goes up, the point that Professor was making. How does investment go up and how does consumption remain contained? If there is one risk that we have today in today's context, it is that we have rates coming, everybody is clamoring for lower rates, let's say lower rates come down. Next 2 years, consumption goes up, asset prices go up, sir, as you said, and that creates, again, the vicious cycle of twin deficits and all the instability that we saw earlier. The lower rates has to facilitate investment, particularly infrastructure, and not consumption. Now, the more macro, prudential norms that you can set aside around that, I think the better for that. And this doesn't depend upon what happens in the market tomorrow. So I think those are things that the central bank definitely has to work on. And
You don't have to say.
I'll tell you what, I've taken enough time anyway, so.
No, I'll request Anas to, follow it up on that.
Me? Communication depends upon the era as well as the time, and based on that, the communication has to be fine-tuned. If you look at the monetary policy of 70s, maybe Fed would not have even talked about the interest rates sort of thing in those minutes. And all this talk of maybe open communication, transmissions, and all those things have happened after the global financial crisis, where essentially you are fighting a crisis. And when you're fighting a crisis, it is always better to be more open, more transparent, and so that all the stakeholders in the economy are kept abreast as to what is a crisis and how are you trying to fight that crisis. Whether you will succeed or not is a different point. But that is how the communication has to happen, because you're fighting a crisis. So that is why I think you saw lots of openness in communication coming, whether it is Ben Bernanke or Ellen. And if you look at the Indian scenario, from Dr. Subbarao now to Dr. Rajan. So I think we are all looking at communication in that fashion. But if you look at the forward guidance that has been given, if it is given out of turn, or maybe let us say if an event has to happen some 2 years before or later, and you start talking about that now, maybe the markets will go for a TC. That is exactly which happened in May 22nd, 2013, when Bernanke said that he will do the quantitative easing rollback. The whole markets globally went for a toss, but actually the event, when it is happening now or now it is completely over, the market didn't react at all. But that is where I think maybe the maturity of the market has to be there. Maybe the way in which the communication is given has to be very much fine-tuned. That is where I think sometimes I agree with you, Dr. Gangadhar, that ambiguity is required. Maybe you need to hold back a little bit or time your communication in such a way that it doesn't do a disruption of the market. Because if it disrupts the market, then automatically from the market, what will happen is it will flow back to the real sector, and the real sector, which is actually trying or struggling to grow, gets into again a sort of a situation where the green shoots of recovery all goes back and it becomes a brown sort of thing. So I think communication is a very, very good, difficult art to practice. And I think the communication has to be done with a sense of, I would say, a little bit of caution. Openness is required, but you need to ensure that you take the markets along with you in a very, very orderly manner. More communication doesn't mean that it is actually more information because of which everybody is going to interpret that information in a manner. Media is not here. We are getting overload of information to us at our desks, and we are all taking decisions based on that. But ultimately, if you ask the quality of the decision making, I don't think the quality of the decision making is that high compared to the earlier maybe period where the information was a little bit lesser. The one thought is, why do we require, let us say, so much of monetary policies? Okay? Whether earlier it used to be 2, the busy season and the lean season, and then it became 4, then it became 6. If it becomes like 12, then I do not know what will happen. So maybe we need to look at it as to how do we share the information. The policy making is happening, let us say the regulatory level policy making is happening once in 6 months. Maybe fine tuning of this market information and taking actions can happen once in 3 months. The bi-monthly policy means it's a 6 month, and every time, like what you are trying to say, the governor says something, the dog looks up. Maybe it is happening like essentially the markets are going for either a TC or the markets are going down, completely down. So maybe more of communication is not a panacea. The quality of communication is the right approach.
Can I just add one thing? Sorry, to your point earlier about communication, and I think Sajid also mentioned this. It's a totality, right? What is said and what the actual action in the background is. I'll give you an example of dollar rupee, right? How many of you think dollar rupee will be 70 in 2 years' time? Can you please raise your hands? Or 70 or worse? So it's about, I don't know, 1%, 2% of the population or so, right? Now, the reality is, since there's a huge amount of uncertainty and we really don't know where the markets are headed, you can't allow complacency in the market, right? Now, all of us think stock markets are going to do great. We are sitting in the right building for that. We think dollar rupee is going to do extremely well, maybe where it is, or maybe even stronger, rupee stronger. At a time a year back, when things were extremely volatile, the RBI had to bring in some stability. It was just too volatile, right? But if you stretch that too much and bring it to a situation where things are very, very stable, then the whole point that RBI is telling us, please hedge yourself, please don't keep exposures high, please ensure your expectations are moderate, that goes away. The need for markets to have a certain minimum degree of volatility and the need for the market to have certain inducements to ensure that actually markets remain slightly hedged or somewhat hedged cannot be, it's very, very important. And it again goes back to monetary policy. If you have monetary policy which is very, very tight, then you actually have interest rate differentials extremely high, which actually incentivizes exporters, disincentivizes importers, and brings back the whole thing about complacency, right? So everything is tight. I think one thing that the RBI has to do is ensure that markets don't become too complacent. Intervention has to be moderated to the extent that there is a certain degree of complacency taken away, that people have the fear of God, and therefore do whatever they can to reduce their exposures.
No, I think the interesting point here, conceptual point here is the following. Should the regulator, in this case the central banker, in its objective to minimize asset price volatility, should it be over communicative to the markets, or should it allow financial innovation and financial products to take care? Once, one of the famous governors, ex-governors of RBI, he once asked me, allowing interest rate derivatives, would it take away the sovereignty of monetary policy in India? It's a very genuine concern. I told him, who is the most powerful central banker in the world? It's Greenspan. And which is the market with maximum financial derivatives? It is US. So the idea is, when we talk about communication, when we talk about market turbulence, managing through communication, allowing market products to evolve to take care of certain aspect of the turbulence, related or unrelated to policy, is also part of the communication in a way. If you try to think, as we were taught, price-based, controls versus quantity-based controls, just the way, economic theory tells us that quantitative interventions can be quite dangerous. I think in the process of actually communicating, if we think controlling certain financial innovation in a random way can actually have side effects. I'd like Sajid to comment upon.
So the way I think about this is slightly differently. I think about communication is an effective tool of monetary policy when your objectives are deemed to be credible. We spoke about the Phillips curve in the US being very flat at 2%. Most measures of slack in the US since 2009 would have suggested deflationary pressures. But the fact is, enough financial market and economic agents were convinced that the Fed would like to keep inflation close to the 2% mark and do whatever it takes to avoid deflation. So the forward guidance worked because those objectives were deemed to be credible. In the Indian case, I think what matters is, in economics, there's something called the assignment problem. How many objectives do you have and how many instruments do you have? And I think credibility stems from having at least as many instruments as you have objectives. The beauty about inflation targeting was, to the extent that you have, most people perceive you have one policy instrument, which is your short-term interest rate, you should only have one objective, which is your rate of inflation. If you believe you have other instruments, FX intervention, you can then introduce another objective, which is the exchange rate. If you believe you have macroprudential measures, then you can introduce another objective, which is financial stability. So I think the thinking about the current framework in India is, to the extent that you believe that policymakers have at least as many instruments as they have publicly stated objectives, there is credibility associated with those objectives, and that's where the communication matters. I think 12 months ago, people looked at Ganga and me like we had come from Mars when we said 8%, 6%, 4%. I think over time there has been a gradual evolution that not only are these possible, but there is a determination on the part of the central bank to only alter the monetary policy stance when these previously defined objectives are met. I think that consistency over the last 12, 13 months adds, in my view at least, greater credence to every successive communication tool as an instrument of monetary policy. But I'll stop there.
Very articulate, very nicely put. Prachi.
I think so two quick points on communication. I think the importance of communication was illustrated by what happened last summer. Given that, the anticipation of tapering created all this havoc in the markets. It was not tapering itself. The importance of communication, that's a perfect example, and that was raised by you as well. And, in line, 2 points, echoing what Sajid said. One is the credibility of the objectives. The other is the credibility of the central banker. Credibility and reputation of the central banker is a well-established, variable in the literature. Basically, inflation targeting, how does it work? Is that, the central banker announces a target and the private sector and the markets form expectations in line with the target, and therefore actual inflation falls because, markets and the private sector expect it to fall. Here, the key variable is, of course, the credibility and the reputation of the central banker. If a central banker announces a target, the private sector and the markets will be led to, form expectations in line with the target if that announcement is credible. Credibility and reputation is built, of course, based on history on how the central bank has performed and the central banker has performed over the, over the historical period. So, just these two, linked to what Sajid said. And one more point, again linked to what Sajid had said in the beginning, there are multiple tools of monetary policy. And actually in some work which we are doing, we actually find that to be statistically different. The effect of quantity instruments versus price instruments are very different. And not only that, monetary transmission and the effect of monetary policy varies even within a bank across different branches. So, the big point being that the effects of monetary policy are quite heterogeneous across the tools, not only across banks, which was well established actually in the literature from work done by Kashyap and Stein, but also, what we are finding is across branches within a bank, actually the effect of monetary policy can differ. So, these are few things to keep in mind.
You see, actually communication is important. But I think there is a very basic problem. See, in monetary policy, which is interest rate based, and that is the fact that throughout the world, banks are operating at the short end of the yield curve, but somehow the short end is not transmitting to the long end. You see? So that long end yields somehow remain anchored, and in spite of the best efforts to bring the long-term interest rate down, by bringing down the short-term interest rate, all that happens is that there is a change in the term premium. Okay? This is the unexpected side product of monetary policy, for which you see there does not seem to be any solution at the moment. Unless it be something like now some economists have started arguing for targeting the long-term interest rate, announcing a target for the long-term interest rate, and this movement, is becoming quite popular among sort of academic economists. But this has not yet caught on. And I think this term premium uncertainty is something which the central banks have really to learn to grapple with. Because howsoever much you operate at the short run, the term premium, is not going to be affected in the direction that you want it to be, right? So the anchoring of the long-term interest rate, which is happening in the United States as well as in India, the long-term interest rate seems to be getting anchored around particular values. And I think this is something which is a very big challenge for monetary policy.
I think, one aspect that's being touched about is the credibility issue. I think one question that we did not have time to discuss is the monetary fiscal policy mix, which has a serious implication on the credibility of the central banker. In the Urjit Patel committee, we jocularly said if central bank governor or the inflation targeting is continuously missed, what do we do? Can we fire the governor? Then the question they said was, by RBI Act, you can't fire the governor, fire the deputy, they said. So there is no legal restriction on firing the deputy, since there are 4 of them. So all that we could, that's how to establish the credibility. But I think the point that is the moot point, with which I would like to conclude, is the following. The communication about the policy, the awareness about the policy has clearly gone up in the recent past. Part of the reason, on a lighter note, even Ms. Shobha is talking about monetary policy of late. And monetary policy has started appearing on page 3 discussions with Raghu Rajan's, rock star image. It is helping our credibility in a way. However, on a more serious note, as the economy becomes financially more deep and people start understanding the importance of financial markets, the monetary policy, alternative channels of mechanism, etc., we are becoming a bit like, not quite the developed nations, but we are going towards that in terms of instruments. The demand for the financial innovation is generating, and that in turn is generating financial deepening, which has consequence to the effectiveness of monetary policy. That's why the title that when we said, the title of Understanding Monetary Policy, the idea was to say that every policy announcement that's going to come in the future, or it has come in the recent past, will have to be, evaluated in the overall conceptual framework of monetary policy rather than worry about the gingerl example which I have given in the past. I wish we had more time because this discussion has generated fantastic food for thought, but food is more exciting than food for thought any day. So I think let's conclude at this stage and hand it over back to Amrish for further proceedings.
Thank you, Ganga. Food or no food, but this was an enlightening. Thank you all the panelists for taking time out being here. May I now request Shri Ashish Kumar Chauhan to please hand over mementos to each of the panelists. I will probably start with the lady first. So, Dr. Prachi Mishra, thank you so much for being here. We much appreciate your time. Professor Dilip Nachani. Mr. Anant Narayan. Our moderator, Mr. Gangadhar Darwa. Mr. Venkatesh. Dr. Sajid Chinoy. And of course, Mr. Neeraj Gambhir. Thank you very much. May I now invite Mr. V. Balasubramaniam to please come over and convey the vote of thanks.
So good evening to everyone. I think it's my pleasurable duty to deliver the vote of thanks. First and foremost, I will start with the lady here. Dr. Prachi Mishra, Advisor RBI. Thank you very much, ma'am, for coming here and enlightening us. Professor Dilip Nachne, sir, thanks for coming. Sri Anant Narayan, a good friend and again, an expert in the markets who is very much on the TV and his opinions clearly today appeal to everyone because many of you are practitioners. I think he echoed all our sentiments. Of course, Sri N.S. Venkatesh, Executive Director and Head of Treasury and International Banking, IDBI Limited. His valuable comments, obviously. Dr. Sajid Chinoy, Chief India Economist and Executive Director, JP Morgan. Thank you for your valuable comments. And Sri Neeraj Gambhir, MD and Head, Fixed Income, Nomura. Again, his comments from a commercial banking perspective. And lastly, but not leastly, Dr. Gangadhar Darba, for moderating this session. Thank you once again, Ganga. Let me also thank all the participants for coming and enthusiastically looking at this. Of course, it's the middle of the week and after the market hours. So thanks for the patient hearing and I hope all of you got enlightened in this discussion. For me, at least, the takeaway is that monetary policy is very much part of economics and economics is all about behavioral science and behavioral science is continuously evolving. So for us, this understanding will continuously evolve. With that, let me thank you and I'll request all of you to join us for refreshments. Thank you.